All right, welcome to the first of three core knowledge videos. These are just sort of, universal reference points. Like the first one here is going to be a summary of the accounting cycle, and we'll go over the 9 steps. Now, those 9 steps are going to be detailed in the first 4 chapters of the book, regardless of which incarnation of the textbook we're talking about. In some cases, it can be 3, but usually nowadays it's been 4. In any case, these steps are universal and have been as you see them right there for quite some time. All right, so this is just a summary of those 9 steps we will cover one at a time in this first video. All right, so this is what you'll see. Basically, it'll be blocked into 3 pieces. So the first block is going to be analyzing transactions, step 1. Step 2, journalizing transactions. Step 3, posting to the general ledger. So that's what will be the first portion here. And the next one will be steps 4, which is prepare unadjusted trial balance. 5, journalizing, posting, adjusting entries. Step 6, preparing adjusted trial balance. And then the last stretch will be step 7, prepare financial statements. Step 8, journalize and post closing entries. And finally, step 9, prepare a post-closing trial balance. Now remember, until you have seen some of the videos or read some of the handouts that accompany the material or the book itself, whatever we're talking about there, some of this stuff might be like, what are we talking about? So again, this is more or less for reference once you've gotten to that point. So if you look at it at the outset of the class, it might seem a little bit, like what am I looking at here? You'll be questioning it because you haven't, covered the substance of each of these elements. So again, this is just a quick place. Once you've gotten that, once you've cleared that hurdle, coming here is like, oh, okay, here's sort of like one-stop shopping for all this knowledge here. All right, so here's the 1 through 3, and what you'll notice about these steps is that they repeat throughout the accounting period. This is what you're going to do over and over and over again throughout the accounting period. This is the repetition of what you're going to be doing here. So step 1, analyzing transactions. Okay, so first, what are you going to do? You're going to start with a source document. Now, source documents cover a wide variety of territory here. So it could be, and again, I suggest it doesn't have to be something that's in hand. It can be virtual as well. That's what you have in the modern work environment, a lot of virtual documents. So some samples there would include invoices. Again, anytime you buy something, usually you'll have accompanying an invoice that describes like what did you buy, how much did you pay for it, and also maybe a breakdown of what your costs are. So that's an important thing. Maybe just a bill for something, like a bill for utilities. Bank statements are often a source of, like for example, when we get to the chapters on bank reconciliations, that'll be your main source for that. Checks can also be included in a source for your transactions, and of course purchase orders as another source. Again, this is just a sample of possibilities. Some cases your source could be just memoranda, internally generated. All right, so after you've analyzed this and you've ferreted out the relevant data, now you can do step 2, which is actually journalize transactions. And again, this process of what we're describing here is more in accord with any chapters where we talk about debits and credits. If you've only gotten to the point where you've covered the accounting equation, we haven't even talked about what a journal is yet, so it's going to seem completely like, uncertain, like what am I even looking at? So you might want to just stop here and wait until you actually cover that chapter and then come back. All right, so again, once you've covered the debits and credits material, again, journalizing transactions. Again, remember, you're utilizing double entry accounting here, so guess what? Every account or every transaction, I should say, should have an effect on at least 2 accounts, and you have to have at least 1 debit and 1 credit, and they have to equal each other. So that's the fundamentals of what you're doing there. Now, when you look at a journal, this is going to be a record of all transactions that have transpired during the period for the company. Again, different companies have different ways of partitioning their journals. Like you don't want to have necessarily it as a complete open record since the beginning of your business, because that's maybe a little bit too all-encompassing. So you might say, after a certain point, we're just going to take some of those journal entries and we're just going to archive them. And if somebody needs to look them up in the archive, they can if they have the clearance that we are allowing them to do that. But that again, it's up to the company. But in general, it's a record of all your transactions. And again, it should reference either like verbally in a line, that's what I'm just saying here, a reference line that says, see, in invoice, number such and such, whatever, or here's a bank statement from this, whatever the particulars are, should all be listed there. Or it can just simply be a link to supporting documents if we're talking about something that's virtual. And you'll note that in academic settings, we commonly omit this just because it adds a little layer of complexity that we don't really need to investigate at this point. But if you're actually doing this hands-on, yeah, you have to have some sort of a reference to a supporting source document. All right, number 3 is going to be whatever you just did there. The journalizing is going to be transferred to and therefore posted. That's how we refer to it as posted to the general ledger. And again, the detail of like how the posting process looks with respect to the journal, that's detailed in another video. This is just a summary of that. So in other words, we took whatever happened in the journal, whatever accounts were involved, and those will be transferred to the ledger. And again, this will be, so if you're looking at a ledger again, this is going to dovetail with the concept of a chart of accounts. I refer to this as your living chart of accounts. My chart of accounts is all the accounts you could use. When you look at the ledger, that's the actual balances of all the accounts in the chart of accounts, which can be anything, obviously, from 0 to something else, right? In some cases, you can have negative balances. Depends on the account. Most of the time, that indicates an error, but in certain circumstances, a negative balance is not errant. For example, retained earnings can have a negative balance, which in this case would indicate a debit balance. It just means the company has experienced a deficit because they're probably a startup and all they're doing is spending money. They're not taking anything in. That's why it's common you will see that happen. So that's what we mean by the general ledger. The process of posting to it, again, is very painless in a modern environment. It's just a matter of just saying post, and it says, are you sure? And then you say yes, and then boom, it happens, which is why I take that process and I slow it down for you in the video that talks about posting. So that'll be, again, debits and credits material that will cover that. All right, so this is the 3 steps that are happening over and over and over again. It's repetition right there. Now, for the last remaining steps, 4 through 9, these only happen at the end of the accounting period. So now we've gotten to the end here. So we're at the end of the month. Usually that's what we're talking about, end of the month. So your first step is going to be to prepare what we refer to as an unadjusted trial balance. Because why? It's unadjusted because we haven't done our adjusting entries yet. It's our first glimpse to make sure that debits equal credits. That's all you're doing there. Debits equal credits is all you're verifying. And as I detail in that video, it does not guarantee the absence of errors because there are other errors you can still make. You can still omit transactions, post them twice, or possibly post to the wrong account. So that's detailed in another video, but that's just a summary of what you can expect. So it at least tells you mechanically you've done everything correct. Debits equal credits. So now you can safely move on to step 5, which is to journalize and post adjusting entries. And usually that also involves a bit of a data collection process to get the basic information of what you need to actually adjust at the end of the accounting period. And again, what you have here is the culmination of revenue expense recognition principles. And again, this is often summarized as simply the matching principle, meaning we're just trying to match the expenses that were incurred during the period with the revenues that were earned during the period. So that's all it is. And of course, that matching culminates in the income statement, so that those 2 elements should sound very familiar to you, even if you've just seen the first stretch of videos and gone through the financial statements. So what are we doing here? We're bringing all of our accounts up to date. And again, they're going to be journalized and posted at the end of the accounting period. So once you've done that, step 6 is prepare an adjusted trial balance. So now what we're doing is we're just once again verifying that debits still equal credits after posting adjusting entries. So it's more of just a form. It's just like a formal step. And also the thing to keep in mind with the adjusted trial balance is this is the source document for, or the source of, the next step, which is going to be step 7, is preparing your financial statements. So all those adjusted account balances are going to be the ones that will be referenced when you're generating your income statement, statement of retained earnings, balance sheet, and your statement of cash flows. And again, remember, the order of these statements is important because this is on the financial statement video. Income statement flows to statement of retained earnings. The result of that flows to the balance sheet, and we need the income statement and actually comparative balance sheets to do the statement of cash flow. So that's why that order is exactly what you're looking at there. All right, so once you've gotten the financial statements done, the truth of the matter is you don't need your temporary accounts anymore, so we're going to generate, meaning journalize and post, our closing entries. So this will lead to the zeroing out of all temporary accounts. And of course, what happens is they get transferred to retained earnings. So we're not getting rid of them. We're just saying they've done their job. We're going to condense them down into just a single place, and that's now retained earnings. Because what you'll notice about all temporary accounts is they're all subsets of retained earnings as defined from like the first set of videos in that first chapter. So what you'll see is that, again, it's a preparation also, because all your temporary accounts in the next period will begin with the zero balance, meaning you're starting from scratch. It's like, okay, they did their job in the last period, and now we're going to start them over. And then you still have one final step here, and that is preparing a post-closing trial balance, which is just what? Final check of debits and credits. So it seems to me we really grind on that point in here, don't we? And that making sure debits and credits are equal, because again, it has to be equal. Now, of course, and this is just my opinion, if you have a good system on your hands, you should never need to check debits and credits. You should never allow anybody to post out a balance, and if that's the case, you never even have to check it. So someday we might come to a point where these various trial balances, and just to recap, again, there are three of them. Again, there's unadjusted, adjusted, and post-closing. And there are ways of telling the difference between all three. The unadjusted trial balance, you will probably note the lack of certain accounts that you would normally see occur only because of the adjusting process. Like, for example, an account like salaries payable, probably not going to appear on an unadjusted trial balance. Right? It's just going to be accounts that you would normally use during the period. So that's how you really can spy an adjusted trial balance, is because the adjusted one is going to have some strange accounts on it, like you'll see salaries payable on it. It's like normally you would never have that account on there, but you'll have it because of your adjusting entry process. So it's really the easiest thing to do is if you're confronted with two trial balances and they have, revenue and expense accounts on them, and you look and you go, okay, which one is the adjusted one? Look for those accounts that you would not normally see during the accounting period, like fees receivable. You're not going to see that during the accounting period. That's weird. Salaries payable. So if it has any unusual accounts, that'll tell you, oh, that's the adjusted one. The one that lacks those is the unadjusted. That's usually how you contrast those. And then lastly, how do you spy a post-closing trial balance from any other trial balance? Simple. It only has permanent accounts. So if you only see balance sheet accounts, same thing. Balance sheet account equals permanent account. That's all you observe. So you only see assets, including contra assets, such as accumulated depreciation, liabilities, common stock, and retained earnings. If that's all you're observing, then you're looking at a post-closing trial balance. If it has anything that would go on the income statement, or if you see the account dividends has a balance, that is not a post-closing trial balance, because dividends is a temporary account that would be closed directly to retained earnings. So again, cannot be on this account. Dividends is the only strange one. In other words, all other temporary accounts you'll see on an income statement except for that one. That's the only one. That's the only one that's kind of in limbo, so to speak. All right, that concludes the summary of the accounting cycle. Again, this is one to feel free to reference anytime, whenever you need to. It's there at your fingertips. Bye for now.